What if I told you that the single most important rule of investing has almost nothing to do with making money? It sounds crazy, right? But today, we're diving into the core philosophy of the legendary Benjamin Graham, and it's a principle that's not about getting rich quick, but about building something that actually lasts. So let's just start with that. What do you think the number one goal of investing really is? I mean, seriously, take a second. What's the very first thing that pops into your head? Okay, so if you thought something like to make the most money possible, or find the next big thing, or maybe time the market just right, well, you are definitely not alone. That's what pretty much everyone thinks. It's the exciting part. But according to the guy who literally taught Warren Buffett everything he knows, it's also completely the wrong place to start. See, the father of value investing himself, Benjamin Graham, he had this totally different way of looking at it. His goal wasn't about hitting home runs. It was about making sure you didn't strike out. For him, you won the game by avoiding big, permanent mistakes. It was all about protecting your capital first, last, and always. So, how do we actually use this powerful idea? Well, we're going to break it all down. First, we're going to find out who the investor's single worst enemy really is. Then we'll draw a super important line between investing and speculating. After that, we'll look at Graham's brilliant answer to an uncertain world, see the incredible legacy that this one rule created, and then finally, we'll boil it all down into 3 principles you can actually use in your own life. All right, first up, the investor's worst enemy. Graham was convinced that the biggest risks you'll ever face in the market, they're not on some chart or in a financial report. Nope, they're a lot closer to home. And there it is. That's his core diagnosis. The biggest threat isn't a market crash or a bad economy. It's us. It's our own brain. It's our greed when everything is going up, and it's our fear when everything's going down. It's that overconfidence that makes us think we know what's coming next. Graham knew that investing isn't really a math problem. It's a behavior problem. And look, this wasn't just some theory for him. This guy's philosophy was forged in the fire of some of the worst financial crises in history. The Panic of 1907, the Great Crash of '29, the Great Depression. He had a front row seat watching incredibly smart people get totally wiped out, not because they owned bad stocks, but because they made bad decisions at the worst possible times. And of course, his most famous student, Warren Buffett, he's just brilliantly summed up this whole philosophy into these 2 simple, unforgettable rules. And he wasn't joking when he said this. This is the absolute bedrock of their entire approach. Protecting your money comes first, second, and third. Everything else is a distant fourth. So this intense focus on not losing money, it leads us right to what Graham called the single most important distinction an investor has to make. You have to know the difference between investing and speculating. Now, Graham's definition of an investment is just brilliant because it's so simple and so strict. Let's just break it down. First, thorough analysis. That means you've actually done the homework. Second, it promises safety of principal. You have a very high degree of confidence you're going to get your initial money back. And only then, third, do you even think about getting an adequate return. If you're missing any one of those 3 pieces, Graham would say you're not investing. You're doing something else entirely. And this contrast is just so powerful, isn't it? An investor analyzes a business to figure out what it's actually worth. A speculator just chases the price on a screen. An investor's main concern is safety. A speculator is driven by the fear of missing out. And according to Graham, confusing these 2 things is probably the fastest way to lose money. Okay, so if we can't trust the market's mood swings, and we know that we are our own worst enemy, how in the world are we supposed to operate when the future is so uncertain? Well, this is where Graham's genius really shines. First off, Graham starts with a dose of brutal honesty that you just don't hear from most financial experts. He flat out admits that nobody, and he means nobody, can consistently predict where stock prices are going. It's a game you just can't win, so don't even try to play it. So if you can't have prediction, what can you have? You can have protection. And his tool for that protection is the single most important concept in his entire body of work, the margin of safety. The logic here is just beautiful. Think about it like you're building a bridge. If you know that bridge needs to hold 10 tons of traffic, you don't build it to hold exactly 10 tons. That would be insane. You build it to hold 15 or maybe even 20 tons. That extra capacity, That's your margin of safety. It's the same exact thing in investing. First, you do the work to figure out what a business is really worth. Second, you make sure you only buy it when the price is way below that value. That discount, that gap, that's your margin of safety. It's your buffer that protects you when things inevitably go wrong. Now, this whole idea of focusing on safety first, it didn't just stay in some dusty old textbook. It became the foundational principle that shaped generations of the absolute best investors in the world. Of course, his student Warren Buffett famously built on the idea. He figured out that buying a truly wonderful business at a fair price could actually be safer than buying a crummy business at a super cheap price. Why? Because a great business grows its own value over time, which means your margin of safety gets wider and wider all by itself. But, and this is the key, he never ever abandoned the core principle. The idea of paying less than something is worth, that remained the absolute foundation. And modern investors like Howard Marks have taken this even further. They've really clarified the difference between volatility and risk. You see, volatility is just the market bouncing around. It's noise. Markets go up, they go down. It can feel scary, but it's usually temporary. Real risk, as Marks puts it, is the chance of a permanent loss of your money. And that kind of permanent loss almost always comes from one mistake: overpaying. It comes from forgetting your margin of safety.
So how can we actually use this powerful way of thinking? Let's boil everything we've just talked about down into 3 simple, actionable principles you can take with you.
Okay, here they are. First, before you make any investment, the very first question you ask yourself is my principal reasonably safe? Second, never, ever confuse excitement and hype with a smart decision. Just because everyone's talking about it doesn't mean it's a good idea. And third, always, always be more worried about how much you could lose than you are excited about how much you might gain. Respect the downside. And here's the thing Graham was so sure of. If you just live by these 3 rules, you don't have to be a genius to do well. You just have to be disciplined. Over an entire lifetime, this steady, defensive game will almost certainly put you way ahead of all the people chasing hot tips and getting scared out of the market every time it dips. And we'll end on this final piece of wisdom. The whole goal is not to have a crystal ball. It's impossible. The goal is to build a solid framework and a tough mindset that allows you to prepare for a future that you know you can't predict. And that right there is the real secret of intelligent investing.